What is payout ratio? The payout ratio shows how much of a company's profit is paid out to shareholders as dividends, rather than being kept inside the business. In other words, it tells you what share of the earnings is being given back to investors and what share is being reinvested for future growth. The formula is simple. Payout ratio equals dividends per share divided by earnings per share times 100. It's not the same as dividend yield, which looks at dividends compared to the share price. Instead, payout ratio focuses on how the dividend relates to profits. Why does it matter? The payout ratio matters because it tells investors a lot about how a company uses its profits. A lower payout ratio often means the company is keeping more money to grow, expand, or pay off debts. A higher payout ratio means more money is flowing back to shareholders as income. For investors who rely on dividends for regular cash flow, this can be comforting and practical. Emotionally, it also gives a sense of security. A company with a stable payout ratio feels dependable, while an unusually high one might raise questions about whether it can be sustained. The right ratio often depends on the type of investor you are. Income-focused investors may prefer higher ratios, while growth-focused investors may prefer lower ratios that leave more room for reinvestment. Here's a simple example. Imagine a company makes £1 per share in earnings this year. It decides to pay 40 pence of that as a dividend and reinvest the remaining 60 pence into the business. Using the formula, that's a payout ratio of 40%. For a shareholder, that means for every pound the company earns, 40 pence goes straight into their pocket, and 60 pence stays in the company to, hopefully, make more money in the future. Another company might have a payout ratio of 80%, which looks generous, but it leaves far less room for reinvestment. Looking at this number across several years is also useful. A payout ratio that stays steady or grows gradually feels more reliable than one that bounces around. What else should you know? Payout ratios vary depending on the type of company and its stage of life. Younger companies, such as those in technology, often pay little or no dividend because they need profits to fuel growth. More established businesses, like utilities or consumer goods, may pay out a higher proportion since their growth is slower and investors expect income. That's why it's best to compare a company's payout ratio with others in the same industry. A payout ratio over 100% means the company is paying out more than it earns, which can't last forever and often signals risk. Special or one-off dividends can also distort the number, making it look unusually high in a particular year. On the other hand, an extremely low payout ratio doesn't always mean bad news. It may suggest the company sees big opportunities to grow and wants to reinvest profits. It's also worth noting that accounting choices can affect the ratio, so investors often look at it alongside other measures like cash flow to see if the dividend is truly sustainable. To sum it all up, the payout ratio is a simple way of measuring how much of a company's profits are being shared with shareholders and how much is kept for future growth. Different sectors have different norms, and trends over time often matter more than a single year. A balanced payout ratio can give investors both income and confidence in long-term growth, while an extreme one, either too high or too low, needs a closer look. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.